Well, buckle your seatbelts because 2021 is coming again, in my opinion. If you guys remember back in 2021, all of the retail investors that were in the market, all of the margin people were using, all of the money people were making, I think we're entering a similar time period today, and that's what I'll be explaining in today's video. But just as a fun fact for you, since the highs in November of 2021, the Nasdaq's up 10%, which isn't great, but from the bottom in just 14 short months, the Nasdaq is up 71%. This has been an insane rally for the stock market. And it all starts with this. This is the Fed's SEP, or Summary of Economic Projections, and they just released a new one where they increased their expected GDP growth for the country, and they decreased their expected unemployment rate, and they actually increased their projection for PCE inflation. So according to them, they expect our GDP to grow much faster than they previously did. They're also expecting unemployment to remain lower than they previously did, which means they expect a very healthy economy moving forward, but inflation to remain kind of sticky. But the big kicker here is they're still projecting 3 rate cuts. And I actually think this is a mistake, but it's not the point of this video. If we get 3 rate cuts, we're going to enter another bubble and probably a melt up in the stock market. But really quickly, if you're new here or returning and not yet subscribed, please subscribe down below. My channel's been growing like crazy. We just hit 30,000 subscribers and we're already almost to 31,000. This is incredible. I'm incredibly blessed by you guys that watch my channel. I just have an amazing community and I can't say thank you enough. Without further ado though, let's get back into this video. So why is this a big deal, you might ask? And it's a good question. The reason this is a big deal is because this is the first time the Federal Reserve has threatened to cut interest rates despite there not being a recession anywhere in sight. You know, previously you'll hear other commentators in the stock market say the Federal Reserve cuts rates or they switch or flip when something in the economy breaks. They're threatening to cut rates despite nothing in the economy breaking this time. Another way to put it is financial crises, or crises, if that's how you say it, have been the reason the Fed has cut rates in the past, not the perception that the federal funds rate might end up causing a recession in the future. There's a big difference here, and we're really risking, with the stock market being up, what did I say, 71% from lows in 14 short months? We're risking the Fed cutting rates, increasing liquidity in the system, loosening financial conditions further, and propping up an already speculative stock market. You might say, how do you call this a speculative stock market? Well, think of AI. Think of the AI trade right now and how popular that is. So if the Fed moves forward with these 3 rate cuts, despite the economy remaining really strong and despite inflation remaining sticky, we're going to enter some sort of bubble or melt up. We're going to have sectors in the stock market that enter overvalued territory. And this is great because we can make a lot of money in a short amount of time, but it's really challenging to try and time the top. You know, in late 2021, nobody was predicting that was going to be the top. Nobody was. And, you know, if you try and time it out, there's a chance that the melt-up rally could just rally another 30 to 40% before something happens and it decides to cool off and correct. So it's really tough to time these things, and that's why through it all I always say to buy undervalued companies that are high-quality companies and sell them when they become overvalued. Now, you have to be able to do your own research and due diligence and put your own price targets and valuations on companies, but that's the way I look at it. If you want my price targets and my valuations, it's made available to my paid monthly members. You can join by hitting the join button located right next to the subscribe button, or you can my Patreon link in the pinned comment. Now, further exacerbating this issue for me is this term called the Fed put, which I believe has come back. It's analogous to put options, where think of buyers in the stock market. They purchase put options to protect any downside they might see in the asset that they own. Well, a Fed put is very similar. It gives buyers of assets a cushion or safety net, knowing that the Fed is going to step in and provide that safety net, and it's going to prevent any sort of downside catastrophe in asset prices from happening. When this happens, the result is always more and more investors willing to take increased risks because there is that safety net to operate within when the Fed injects liquidity and loosens financial conditions, which is what they're saying they're going to do. In a scenario like this, usually small caps and crypto, so think Bitcoin, even the crap coins out there, you're going to see outsized returns in those things because, again, it's more attractive to take risks because the Fed is taking risk out of the system when they have this Fed put that's active, that they're basically saying they're going to indulge upon again. It's very evident that investors love this new Fed put that Jerome Powell is out there with. Let's just look back to November, which is basically when they started to talk about rate cuts. Every single time he's had a presser, the stock market has rallied in the following weeks. This is essentially when the Fed put got put in place in November of last year. And after every Fed presser, again, the stock market has rallied significantly. So the question is, when does this end? And my answer to that is, I don't know. Nobody knows. This could go on for 12 to 24 months. That's what makes timing a melt up or a bubble in the stock market really difficult. It's exciting. We can make a lot of money in a short amount of time. But like I've already mentioned, it's very difficult to navigate. Now, at the beginning of the year, the markets were actually pricing in 6 rate cuts from the Fed in 2024. Thank God that we corrected that and the markets are no longer pricing in 6 rate cuts. That would be a disaster waiting to happen. We can look at the federal funds rate futures 12 months out compared to the nearby federal funds rate to see what the markets are pricing in for future rate hikes or rate cuts. As of now, according to this and the federal funds rate futures 12 months out, investors are expecting 3 rate cuts in 2024, which makes sense because that's what the Fed has been projecting for months now. Another thing we can look at is the federal funds rate versus the 2-year Treasury yield. And this chart shows that investors are pricing in 2 to 3 rate cuts in 2024. So right now, it's evident the markets are pricing in 2 or 3 rate cuts, leaning towards that 3 number. Now, in my opinion, I think the Fed should cut a maximum of 2 times this year, and both of those times should take place after the presidential election in November. Maybe you're wondering why I'm so worried about this. You know, cutting rates is usually a good thing for stocks, and it is. We're going to see tremendous upside, but the long-term consequences are things that people aren't weighing right now. Think about asset prices everywhere in the stock market. It's at all-time highs. Think of real estate and housing, all-time highs. Think of land prices, all-time highs. I come from a farm family. Land is selling for outrageous amounts of money right now. You have the price of oil, which has been climbing steadily, and the price of oil seeps into all aspects of our economy, whether it be businesses or consumers. It's how we transport things. And if the price of oil and gasoline is going up, it means that companies have to raise prices to offset that margin loss of increased prices for energy, which obviously is the definition of inflation. So I'm worried right now that because a lot of asset prices are at all-time highs right now, and the Fed is still threatening to cut rates 3 times this year in 2024, our asset prices that theoretically are already teetering on the bubble territory are officially going to enter the bubble territory. And asset prices are going to appreciate greatly, which creates a wealth effect. Everybody feels wealthy because the value of their stock market portfolio is up, their retirement portfolio is up, the value of their home is up. They spend more money, and what does that create? It creates renewed price inflation. So this is oddly reminiscent of the 1970s right now, where we had 2 bouts of inflation caused by a surge in energy prices. And this is something I'm going to be keeping my eyes on because this is very important. We could make a lot of money over the next 12, 16, 24 months, but eventually the melt up is going to melt down and the bubble is going to pop. And it's really difficult to guess when that stuff is going to happen. Just a couple weeks ago in front of Congress, Powell basically said that they were close to cutting rates. And we kind of all thought he was going to back off that comment after we got hotter than expected CPI and inflation data. But he did the opposite. He basically just dismissed the new hotter than expected CPI inflation data, saying we've had 9 months of 2.5% inflation, and then just the last 2 or 3 months have been elevated, and that it just remains a bumpy road, but they're overall confident in the trajectory down to 2% inflation. I have to say I am too, but only if the Fed doesn't cut rates 3 times, and only if they wait till after the presidential election. You can see it depicted on the screen in this chart right here. The PCED core inflation rates, 3 months annualized and 6 months annualized, are starting to pick back up. And this is the bump that Powell is talking about. If this continues, you're going to see the 9-month and the 12-month annualized rates also pick up, which could be very dangerous, and obviously if that happens, investors will start to get worried and concerned. And all it would take is the Fed threatening to raise rates again for the market to crash. And that's, again, dangerous territory that I think our sailboat is headed towards right now. I'm not saying I'm correct. I'm not a financial advisor. I'm just a 22-year-old that's nerdy enough about the stock market to have a YouTube channel that talks about it all the time. But it's something I will promise to you that's going to happen. People are going to lose sight of reality. They're going to want rate cuts because nobody wants to feel pain. Everybody wants loose financial conditions. Everybody wants their portfolios to skyrocket, myself included. But reality is, long-term, that's not a good decision for our economy, at least in my opinion, based on the data points that I'm tracking. So when you hear other influencers or people on CNBC talking about rate cuts and we need more of them, take a step back, think about reality, think about the asset inflation that it might cause and the ensuing resurgence of price inflation that it might cause. Just take a step back, take a deep breath, and really analyze things. You know, in 2021, that was our problem. That was my problem included. I got lost in the sauce. I got lost in all of this hyperbolic price action and everybody's saying this is going to be the next asset that moons. This is going to be the next stock. This is going to be the next crypto. I got lost in that, as did a lot of investors, and it was easy to. Money was free back then, right? Everybody had money to invest. Everybody had money to gamble in the stock market. And right now, I think there's a very good likelihood that that's the trajectory we're on again, that eventually we're going to reach that point. And maybe when we reach that point, I'm hoping that because you watched this video and because you follow my channel, maybe you'll be more willing to take a step back. Think realistically instead of emotionally about your finances going up in a straight line. I just hope that by coming across my YouTube channel, everybody ends up better financially than they were before coming across it, regardless of whether or not they agree with what I say. I always encourage dialect comments, so if you disagree with anything I've said in this video, don't hesitate to comment down below. Tell me where I'm wrong or where you disagree or think differently. Also, we have Discord on this stuff all the time in Discord, I guess, so you get access to my Discord server again by hitting the join button located right next to the subscribe button or hitting my Patreon link in the pinned comment down below. With that, I'm going to end this video here. I hope you guys enjoyed this. It was a shorter one, but I think it's probably one of the more important videos I've ever made. I can't talk, apparently. So, yeah, please subscribe. Please hit that like button and leave me a comment. I love seeing all the new faces on the channel. The channel's been growing like crazy. I'm extremely blessed. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.